Welcome to the SoTrue Business Channel. Today, I am here to discuss the business income tax system in India and to provide a comparative analysis with 10 other countries. Understanding the corporate tax structures across different nations can shed light on the competitive landscape and economic strategies of various economies. Business income tax in India. India's corporate tax system has undergone significant changes in recent years to make it more competitive. For the financial year 2022 to 2023, the corporate tax rates in India are as follows. On that note, welcome to the SoTrue Business Channel at the BIGRED MAMMOTH NETWORK. Please do like, subscribe and share this video so that we are able to bring you high-quality content on life-changing subjects on a weekly basis. Please also do see the video to its end as it will bring you valuable, life-changing thoughts to think about. Do contribute to the SoTrue Business Channel, which will help us keep reinventing ourselves and improving the quality as we go along this journey. Domestic companies. For companies with a turnover up to 400 Indian rupees crore, 25%. For companies with a turnover above 400 Indian rupees crore, 30%. New manufacturing companies, set up after October 1, 2019, 15%, plus surcharge and cess. Other companies, 22%, plus surcharge and cess, without exemptions or incentives. Comparative chart of business income tax rates. To provide a broader perspective, let's compare India's corporate tax system with 10 other countries. Country standard corporate tax rate special rates/notes. India 25% to 30%, 15% for new manufacturing companies. United States 21%, additional state taxes may apply. United Kingdom 19%, planned increase to 25% from April 2023. Canada 15%, provincial rates range from 0% to 16%. Australia 30%, 27.5% for small businesses. Germany 15%, plus trade tax, approximate 14% to 17%. France 26.5%, reduced to 25% from 2022. Japan 23.2%, local enterprise tax and inhabitant tax apply. China 25%, 15% for high-tech enterprises. South Africa 28%. Brazil 34% includes social contribution tax. Analysis and insights. Competitiveness. India's corporate tax rates are competitive, especially with the reduced rate of 15% for new manufacturing companies, which is among the lowest globally. Standard rates. The standard corporate tax rates in many countries are in the range of 20% to 30%. India's rate of 25% for smaller domestic companies and 30% for larger ones is within this range. Special incentives. Many countries, like India, offer special rates or incentives for specific sectors or new businesses. For example, China offers a 15% rate for high-tech enterprises, and India offers the same rate for new manufacturing companies. Additional taxes. In some countries, additional taxes such as state taxes in the US or trade taxes in Germany can significantly affect the overall tax burden on businesses. Conclusion. The business income tax system is a crucial aspect of a country's economic policy, influencing investment decisions and business operations. India's recent reforms aim to create a more attractive environment for both domestic and international businesses, while maintaining a balance between revenue generation and economic growth. As we look at the global landscape, understanding these differences can help in shaping policies that foster a competitive and vibrant business environment. Thank you for your attention. I hope this speech provides a clear and comparative overview of business income tax in India and other countries. If you need further details or explanations, feel free to ask. Certainly. Here are more details on the business income tax systems in India and the comparative analysis with 10 other countries. Business income tax in India, detailed breakdown. India's corporate tax system is designed to cater to different types of businesses and their specific needs. Here are the detailed rates and conditions. Domestic companies. Turnover up to 400 Indian rupees crore, the tax rate is 25%. This rate is aimed at benefiting small to medium-sized enterprises. Turnover above 400 Indian rupees crore, the tax rate is 30%. This applies to larger enterprises. New manufacturing companies. Companies incorporated after October 1, 2019, and commencing production before March 31, 2023, are taxed at a reduced rate of 15%, plus surcharge and cess. This incentivizes new investments in the manufacturing sector. Other companies. A flat rate of 22% plus surcharge and cess is applicable to companies that do not avail themselves of any exemptions or incentives. Further analysis and insights. Effective tax rates. While the headline corporate tax rates provide a basic comparison, the effective tax rates can be quite different due to additional local taxes, surcharges, and special incentives. For instance, Germany's effective tax rate can be significantly higher due to trade taxes and the solidarity surcharge. Special incentives and sector-specific rates. Countries often provide lower tax rates for specific sectors to encourage growth in those areas. For example, China's 15% rate for high-tech enterprises and India's 15% rate for new manufacturing companies. Tax reforms and trends. Many countries are in the process of reforming their tax systems to remain competitive. The UK, for example, planned to increase its corporate tax rate to 25% from April 2023, reflecting a global trend towards adjusting corporate tax rates in response to economic conditions. Impact of additional taxes. In the US, state taxes can add to the federal corporate tax rate, resulting in a higher overall tax burden. Similarly, in Japan, local taxes can significantly increase the effective corporate tax rate. Conclusion. The business income tax system is a critical factor in a country's economic landscape, influencing both domestic and foreign investment decisions. India's recent tax reforms aim to create a more favorable business environment, particularly for new manufacturing ventures, aligning with global trends of competitive tax rates and targeted incentives. Understanding these international tax structures and their implications can help policymakers and businesses navigate the complex global economic environment more effectively. Thank you for your attention.